Good morning, everyone, and thank you for joining today's event. I am Marius Alvenha, one of PSG Asset Management's fund specialists. We always try and add value with these sessions, which I'm proud to introduce you to Dr. Iraj Abedian that will assess the current economic climate for us. Dr. Abedian is a graduate from the University of Cape Town and holds a PhD in economics from the Simon Fraser University in Canada. He taught at UCT for over 18 years and was a professor of economics before joining Standard Bank as group chief economist in the year 2000. Before I hand over to Dr. Abedian, I would like to thank those of you that have sent in your questions. We will spend the last 15 minutes of today's session unpacking those. Lastly, I would like to mention that we have applied for CPD points for this and would like to provide that to all of you who are able to stay for the full hour. So without further ado, over to you, Dr. Abedian.
Thank you very much, Marius, and welcome everybody. Welcome to the seminar. I have put a presentation which consists of 4 segments. I'll begin with some introductory remarks, which essentially captures or summarizes in the form of an executive summary what I'm going to share with you in details in section 2, 3, and 4. Beginning with the global economy at the moment, one word that describes the global conditions are volatility, macrofinancial trends in both developed and developing countries. But particularly developing countries are on the receiving end of it. Countries like Brazil, Argentina, Turkey, South Africa, India, so on and so forth, are on the sort of more vulnerable side. And this is mostly because fiscal and monetary policy paradigms have shifted. And more, they are drifting away from the conventional. What we had learned and taught in the textbooks are often ignored by central bankers, by credible treasuries such as the United States, UK, and OECD more broadly. So the change of paradigm in policymaking is a very critical issue that causes massive volatility, almost as if the global macroeconomic paradigm has lost its anchors, the 2 key anchors being fiscal and monetary policy. So emerging economies, on top of the global instability in macrofinancials, they have their own socioeconomic and political uncertainties, each of them for a different reason. 2 weeks ago, I was in a seminar with our colleagues from Brazil and China, doing a joint seminar. And when I listened to the Brazilian colleague, who, by the way, was the ex-governor of the Reserve Bank of Brazil for a short period, even a few years later, the Minister of Finance, he was saying that he's never, ever experienced Brazil and the political economy of Brazil in such a worrying and uncertain situation. Well, I was listening to it and I was sitting in South Africa thinking, well, that's pretty much my experience here. Over the past 30 years, we haven't had such a almost chaotic, at times irrational, at times counterintuitive, based on economic principles, policy making or decision making. And then I was listening to our Chinese colleague, who we always think China is sort of well organized. They've got their 50-year plan, and they don't go off the script, so to speak. And yet my Chinese colleague was saying, well, at times he can't make sense of decision making in China. So emerging economies, depending where you're sitting, you have a set of circumstances that makes you wonder, scratch your head and say, well, things have never been so bad. And that's because emerging economies do not obviously have political stability as much as some of the more established democracies. Of course, when I look at the United States and UK, you might even sometimes wonder if they have even lost their so-called democratic platform, which gave them stability. So all of these create a basket of variables or a lethal cocktail of factors that causes political and social uncertainties. All of them in some or other way leads to instability. The South African situation is very much driven by the global economy. We are a small fish in a big pond, and we are recovering from COVID, but our growth has been primarily driven by the global economy. Just about all of the domestic drivers of our growth, by that I mean the level of investment, the level of household expenditure, the level of job creation, and so on and so forth, they are at the moment in a very muted state. So our economy is growing primarily through drivers that are global. As we have seen this year, almost all of our growth has been driven by commodities and commodity prices and the robust demand for these commodities, especially precious metals. The global economy is expected to grow 6%, which is a bounce back from the previous year, and the South African economy, in a way, well placed to benefit from that as far as the global economy is concerned. Of course, we do have our headwinds. We all know, as I mentioned, in whichever and whatever emerging economy you are, you have your own domestic headwinds. We have infections, situation of a stop-go that is not good for economic growth. It's not good for consumer sort of confidence, nor is it good for business confidence. But be as it may, we are now sort of winding down or closing the chapter on Delta variation of the vaccine, of the COVID, and we've done relatively well, despite the fact that our vaccination started very slowly and very poorly. But for the moment, our pandemic is under control. However, there is a growing, at least scientific warning by our local and international experts that we should expect another potential fourth wave, and that might hit us in December or thereabout. But all these stop-goes are very bad for the economy. The nature of economic activity that it needs some level of stability, some level of continuity for consumers and for businesses to stabilize their expectations. Of course, the South African vaccine rollout is an important indicator, and to the extent that we are falling below the global percentage of population vaccinated, it is a cause for concern. We are hovering around 20%, whereas many countries are in the 70 to 80%. And that is the challenge that we need to not slow down on. Of course, we are dealing with all kinds of traditional and very unconventional kind of opposition to vaccines, which causes complications for us. If you look at the setbacks that we've had on top of the pandemic, which was generic for the global economy, we had our July unrest, which was absolutely the wrong thing at the wrong time in the wrong proportion, which took a great deal of confidence and caused a great deal of damage to the economy, simply because that those riots were by design or otherwise aimed at our key infrastructure. As you know, the Durban port is significant for our global trade, our exports, especially for our fresh produce and all other general commodities as opposed to mining. And it was quite detrimental to both confidence and to the sheer setback to the GDP growth. And of course, globally, it did not help us at all. However, at the global level, as I mentioned, economy is bouncing back. There are indications and signals from major central banks that financial conditions may begin to tighten, That means interest rates in the United States will begin to slowly go up, and followed by UK and EU. Of course, some countries have already begun to tighten, but those are smaller countries. Of course, alongside that, as I mentioned earlier, we have a situation where the fiscal side of the macrofinancial at the global level are also volatile. Most importantly, and possibly the single largest variable in terms of decision making, is the American infrastructure program at the moment, which is in front of the Senate and the Congress. The parties, the Republicans and Democrats, can get some kind of consensus going, and more recently and somehow unexpectedly, even Democrats amongst themselves cannot agree on the size and the composition of that massive, almost historic level of fiscal intervention. We are talking about a figure of $3.5 trillion that would dramatically affect the financial market, not just in the United States, but also in global terms. In particular, because that means if it's approved at a level of $3 or above trillion, that would mean literally printing trillions of new dollars into the market, which, as you can appreciate, would have impact on relative prices and exchange rate, but at the same time on the growth sides will affect the medium term, meaning 3 to 5 years future growth for demand for a whole lot of products manufactured and commodities, and that's conducive to growth. At the same time, it's going to put incredible pressure on inflationary dynamics in the United States and globally. So these are some of the unknowns which central bankers have to begin to get their minds around. But the bottom line of it is, in one form or the other, very soon interest rates have to go up. How fast and how quick would depend on some of these fiscal interventions that the United States is contemplating. And of course, central bankers have communicated. Fed particularly has communicated that they may have to bring their decision in terms of interest rates a bit earlier, but they're waiting and sort of making their decisions conditional upon what volume of fiscal intervention the United States Senate finally approves. That would depend on the pace at which and the quantum with which interest rates in the United States will go up, and that would have domino effect on the rest of the economy. Of course, what's absolutely critical to bear in mind in this cocktail of factors contributing to uncertainty and potential volatility is the level of global debt. Government debts have escalated beyond recognition, beyond all the accepted norms, whether it was the IMF norms or Maastricht Treaty or whatever norms in the textbooks we had. All of those norms have been broken and exceeded by far. And that's a serious issue, not just from a financial and fiscal point of view, but importantly from a political point of view. When governments do not have the headroom to provide emergency relief because they have overextended themselves, partly as a result of response to the pandemic and partly because of other poor decisions, that creates social instability and fear. I'll come back to some of those points more detailed. So short-term consequences of the pandemic worldwide, we know. It has started with a public health problem. It mutated into a fiscal problem in the sense that governments just spent, and that now has mutated to socio-political issues, ideological issues, and so on and so forth. So we're going to see a succession of a domino effect of one crisis mutating to the next, and that will take another 3 to 5 years globally to stabilize. In the language of economics, to go from one equilibrium to another. I know we're all talking about the normal and the new normal and so on. In economics, normality doesn't make sense. As an economist, I relate to what's the set of equilibrium, sustainable set of configuration, as opposed to a new equilibrium. And in my view, it will take another 3 to 5 years before we can discover or arrive at a new equilibrium. One of the key requirements of arriving at a new equilibrium is having a credible leadership, both at the national and political and the global level. And one of the most scarce commodities at the moment is exactly credible leadership at the global level. And it becomes daily more important because the global economy has integrated, whether people accept it or not, whether ideologies recognize it or not, the interdependence of nations is a fact. Therefore, political leadership at the global level matters for all of them, for the developed and developing nations. Gone are the days that the developed nations could say, well, we are okay. It's really this emerging economies or third world countries that they cannot get their act together. The fact is, if some segments of the global economy, from a political economy, from a social and stability and volatility point of view, if one section doesn't get its act together, the rest will suffer too. Okay, let's just against that background review some of the details. As I mentioned, we all know 2020 was a year of pandemic that hammered the global economy, but we see a very sharp comeback, but then it's mellowing down. In this context, the sub-Saharan Africa, which is that red bar, is on sort of lower end, almost at the bottom end of the growth or expected growth trends. That, of course, does not mean that all the economies are equally bad in the sub-Saharan Africa, but it does mean that sub-Saharan Africa needs to once again coordinate its policy making and get to a point where we were, if you look at that trend in 2012, 2013, or even 2010, we were sort of above many other regions. And that's the position in which that we need to work ourselves back. Can we do it? Of course. Do we have the resources and the potential? Yes. What would we need is a lot more coordinated and synchronized policy making in the region. In terms of vaccination, which is one of the key drivers of economic revival, these are some of the figures to show you how the world economy is administering. And please note, this is about delivered as opposed to administered, availability as opposed to vaccination. And we see that obviously advanced economies have a lot more than what they need, whereas the emerging economies are the other way around. But even when vaccines do exist, they are not administered because there are social resistance, or because they do not have the logistical capabilities, either on having qualified nurses or clinics or delivery of those vaccines. Talking to somebody in the DRC the other day, I've never been to the DRC, but was explaining to me that to go from one town to the other, from one region to the other, is impossible unless if you can fly, if you can have a helicopter or by plane, and in most places helicopter, because there aren't landing for the planes. So these are some of the logistical issues that many emerging economies, and particularly in Africa, we face. So there's the issues of policy support. There is, as you know, vaccine nationalism, which is playing in the background, and the people clawing back to their nationalistic partial thinking is a very serious issue for bringing stability to the global economy. Vaccine procurement is another issue. Some cases there is vaccine hoarding in the United States and UK. and in France, by the way, and yet it's slowing down the global economy's revival. At the same time, most population in the emerging economies are not vaccinated. Potentially by the end of the year will not be vaccinated, and it takes us to the next year, and who knows thereafter what type of resistance and complications from a political and social point of view we might have. In this slide, this is the trend South Africa. South Africa's vaccination campaign got to a very slow start, almost becoming desperate by June. But since June, we can see a very solid ramp up. At the same time, we see, my apology, we see South Africa positioning itself not only to vaccinate its own population, but also to provide vaccine supply for the continent. That is in the recognition that this notion of supplying, manufacturing them in UK, US, or China and flying them is just not sustainable over time. And the emphasis here is not just on COVID-19, but going forward, a great deal of globalization concepts, such as China is the cheapest place, therefore make China your manufacturing factory and bring everything that you want from China, over long term is not sustainable. And COVID-19 demonstrated that it is not just about where you can produce the cheapest vaccine. It's a question of how quickly can you get it into the regions that are needed in order to be able to contain the damage that a situation or a case or an event such as COVID-19 can create for the global economy. So to the extent that that level of decentralization, if you like, regionalization has been put in motion, we see South Africa positioning itself to become the manufacturers of J&J, Pfizer, and our companies such as Aspen are being well placed. And going forward, not just for COVID-19, but also for all other potential vaccines that inevitably we will have in the next 50 years, South Africa is well placed to take advantage, or if you like, to become one of the hubs for manufacturing and distributing such vaccines. So these are very positive, almost unexpected, but positive consequences of the pandemic. The same I might as well say here, that it's not just about vaccine, but in a whole lot of other areas. Localization of manufacturing and regionalization of manufacturing has been one of the positive impacts of the pandemic that many countries have positioned themselves to benefit from, and South Africa is one of them. It's one of the, in my view, one of the key areas that South Africa going forward needs to and is able to utilize or exploit, if you prefer, in order to attract investment and to re-establish new set of industries in the country. What are the impacts? If you look at the global comparison between emerging economies, you see on the left, India, Mexico, South Africa, and Argentina were the hardest hit. And on the other side, you see countries that did not suffer as much. And that had to do with the fact that pre-pandemic, in other words, if you go to 2019, December or November or October or Q4 of 2019, these economies were already vulnerable. We know South Africa was in a state of technical recession even before the COVID-19. Likewise, the other countries, Argentina and Mexico. So the vulnerabilities or systemic vulnerabilities of South Africa was a major reason for COVID-19 pandemic hitting us so hard. And that's a very serious concern from a political, economy and social point of view, insofar as we should not be in a way misled by the 6% growth or 5% growth from last year, because even if we grow 5% this year and 5% next year, we still end up where we were back in 2019, which was not a comfortable place to be. So a lot of these systemic vulnerabilities that our economy had positioned us very, very poorly in terms of global ranking. However, the positive side of it is that we do have a great deal of opportunities to exploit from an investment and from growth promotion point of view, and of course, very importantly, from a job creation point of view. And that's simply because a lot of issues that we were discussing in 2018, 2019, broadly in three areas: policy reforms, investment in our infrastructure, and containment of abuse of fiscal resources, alternatively known as corruption. We need to deal with those three in a systemic way. Of course, you have seen the growth bounce back, as I mentioned, but as you can see, this growth bounce back brings us to a position that back in 2000 and let's say 8, 9, and before that, be getting to those levels if we sustain our growth at a level of 4.5% to 5%. We had 10 years of the economy, the so-called last 10 years or destructive 10 years up to 2018. We need to catch up with that. We need to repair the economy, repair the institutions within the economy, and those are on the face of it massive political challenge, but from an economic point of view, considerable growth drivers if we get them right. And if we focus on them for long enough, we will be able to unlock the capacities that exist within the economy. So these are some of the contributors, as I mentioned earlier on. The July unrest was extremely destructive for our economy, and it will take a couple of years to recover from the damage that is done to our reputation and to our infrastructure. What are some of the key impediments that we have to deal with? On the policy side, we all know, we have discussed it for 10 years. These are some of the policy reforms that we need to deal with. At the level of fiscus, our fiscal situation is vulnerable. But on this front, we are not the only country, as I mentioned. There isn't any economy at the moment that is in a fiscally strong position. Even countries like Switzerland and Singapore have been on the receiving end of it, small and organized as they usually are. One of our biggest and weak links of our economic landscape remains our state-owned enterprises. These enterprises were the platform for daylight robbery. They hollowed out both financially and from a human resource point of view during the Zuma administration, and we have not made sufficient reparation and reform and restructuring of these SOEs to enable them to act as a platform for underpinning our growth going forward. These are critical elements of our growth recovery. Most importantly, and for the immediate future, our port infrastructure, our Transnet and all its associated subsidiaries, Portnet and pipelines and railways and so on and so forth, they remain in a state of seriously damaged and suboptimal operation from an efficiency point of view, and they don't have the capacity to invest where they should be investing, upgrading their technology and upping their productivity levels. So that remains the weak link of our economy. On the positive side, there remain the opportunities for productive investment. Power, we all know, ESCOM, and as much as we focus on ESCOM, in my view, and I've been fairly vocal on that issue, that our problem is not ESCOM. Our problem is our approach towards energy sustainability in the country. ESCOM obviously is a big chunk of that, but cannot and should not be the only source of energy policy. or the only focus of energy policy. So yes, however you cut and paste it, electricity and availability of power, reliability and cost effectiveness. Those are the three issues that we need to deal with, and we have lost control of that paradigm of thinking, which causes a great deal of harm to our economy, causes instability, and slows investment in some areas down. Ironically, this is the area, because of the recent changes that the president has made under duress, this is the area that at the moment is the largest source of domestic capital formation or investment in new infrastructure. And that is mostly in alternative solar, wind, and other forms of power. To the extent that some of the municipalities like Cape Town and others are now engaging directly with the investors, to the extent that many corporates and many medium-sized businesses are now getting to go off grid and think of investing, and they are investing in alternative sources of power. That has become the driver for reviving the economy at those levels. Many of the mining companies have made plans to make their reliance on Eskom as little as it can be, and that trend is unstoppable. No matter what the minister says and no matter what the cabinet decides, the market has now got its own momentum and will continue, in my view, and it will be a source of investment and job creation as well. From a governance point of view, our governance was never strong, but for the past 10-15 years has become really weak in many areas. And this governance issue is not just a political governance. If you in corporate governance also, we have had some of our corporates going down, the Steinhoff, you've seen other corporate crises that we've had. And broadly, this is an issue that South Africa needs to deal with. From having been one of the top 10 by OECD standards 15 years ago, we have now fallen off the cliff almost completely. So the issue of governance is both in political, which is of course very, very critical for SOEs and for the trusteeship of fiscal resources, but also outside governance. Unemployment remains the country's Achilles heel. Before COVID, we were in a desperate situation, and post-COVID, it has become a time bomb that has become a lot more structural, a lot more intractable, and a lot more complicated. The fact that we have a seminar where we have now means a lot of jobs in this industry has gone, and they're not going to come back. In many, many industries, the digitalization, automation has permanently destroyed low-skilled jobs and has displaced the geographic location of jobs across the globe. And that's the reality. And South Africa and many, many other countries that were not in a comfortable position with respect to job creation, they have become even far more uncomfortable than before, and we need to rethink very seriously about some of our options. So our unemployment at the moment is officially above 33.5, but quite frankly, amongst the youth, it's almost 70 to 75% in some regions. And that's a very, very critical problem. We have, alongside with countries like Brazil and then which increasingly feel the consequences. And that brings us to another important side of the political economy of growth and unemployment and social welfare, and that is the concept of shared prosperity. As you can see here, in the decade 2005 and thereabout, South Africa was far better ranked globally when it came to shared prosperity, meaning the level of job creation, the type of jobs, and the growth in job creation was incredibly, better than what we have at the moment. We have now become part of the last almost 10% of the ranking countries, and that's a serious problem even within sub-Saharan Africa. And that essentially means a blend of slow policy reform, digitalization, and radical changes in the composition of labor force, and the fact that our policies are not aligned in terms of infrastructure and investment to not just create growth, but make sure that the growth is shared within the economy. This lack of shared growth is a serious issue globally, but of course in countries like South Africa is a lot more consequential. Just for your information, the definition of shared growth is when, and this is obviously for illustration purposes, it's to show the consumption of the bottom 40% of the population as the total economy. And that essentially is driven by level of job creation, type of job creation, and type of synchronization of various sectors. In the emerging economies comparison in South Africa vis-a-vis others, you can see in this picture that South Africa is below average, together with Brazil, Argentina, and some other countries, obviously China, are the drivers of this average. We need to focus. We know the President Ramaphosa, has been fairly vocal and hyperactive in terms of mobilizing resources for it, at the same time focusing the attention of the nation on the importance of this. And yet infrastructure investment and investment more broadly does not happen quickly. It is something that takes time for the investors to have confidence. It takes time to get the institutional setup done, and therefore it requires sustained emphasis on investment, clear definition, and very importantly, supportive, or if you like, favorable legal and legislative one. To just highlight two of them in South Africa, there are many, many others. We don't have time for it to go into details. For example, lack of a spectrum, which has taken now 5, 6, 7 years to discuss it and not do something about it, is an issue. Slows down investment, it slows down productivity. Likewise, the issue of power. I've been in a discussion around power and approaches to energy generation in the country since 1998. That's more than almost 3 decades, going to a 3rd decade. And in many areas, we are on the same spot, and these are not helpful. On the positive side, more recently, there has been sort of sustainable infrastructure development symposium. There is at least attention to it, and there's been some policy changes with respect to energy that we've seen the results, and that in a way is quite indicative. You change one policy from 20 megawatt to 200 megawatt, you unleash and unlock a huge amount of investment and jobs. In terms of our sovereign rating, we know that we are sub-investment grade or junk grade, but here look at the company that we keep. In this middle area, light brown, we are in the company of Russia, South Korea, Turkey, and Brazil. This is the combination that does not help us either in the global ranking or in global sort of assessment of the level of risk that we increasingly have. At the moment, you don't want to be in the company of Turkey and Brazil. These are highly problematic political environments. And of course, if you're sitting in Brazil, you say the same thing. You say, I don't want to be in the company of Turkey and South Africa because they are highly political. And if you're in Turkey, likewise. So that's what earlier on I was saying, that the emerging economies have found themselves in a very, very uncomfortable situation. Of course, I was talking to a friend of mine 2 days ago in London, and she was complaining that they don't have petrol, and they're worried that food may run out because of the British Brexit policies. So in different countries, different and new risks have emerged. To just give you an idea of the level of debt that I mentioned earlier on the left, you can see how rapidly our debt grew from 2008, and this is the Zuma squandering and daylight robbery, the Gupta Zuma project, and 2020 is mostly the pandemic, which, by the way, is not finished yet. In terms of global comparison, you can see here, whereas in 2020, those red dots show where they were. Before that, averages were, with the exception of countries like, let's say, India, many countries were getting their debt under control. But it's a mixed bag. There isn't a consistent and uniform trend. So these are the domestic environment that, for example, moves the Indian situation different from Brazil, or South Africa different from Russia. But however we define it, the one fact is common amongst all of them: all their public debt levels are beyond the sustainable level. South Africa is obviously where our sort of most attention is. At the moment, we are around 70% mark. We have rebased our GDP. That has helped the ratios, but the ratio, in my view, is not important or as important as the sustainability. And the sustainability has to do with rate of interest and the level of government revenue. If you end up increasingly higher proportion of your revenue being spent on sustaining debt, that becomes unsustainable, and that's the figure that we should focus on. I don't mind whether the debt is 100%, 50%, 20% of the GDP, if it's sustainable. If it's not sustainable, any level is conducive to macroeconomic instability and disruption. And that, in a way, affects the government debt, government yield, and not just short-term but medium-term taxation level. Because when governments cannot sustain their level of debt and they are not able to cut their expenditure, they end up having to tax their citizens, and that's where we run into different types of structural problems. So South Africa, again, in line with countries like Brazil and India, they haven't tried to change the composition of their borrowing. Some countries did. They went for short-term borrowing, reduced the cost of borrowing, but those are short-term plaster over the wound. It does not deal with the real issues that government debts have become unsustainable. Governments are under pressure to spend no matter what because of the pandemic, and therefore their debts get even more out of control, and that takes us to a situation that conventionally we refer to them as the need for a structural adjustment at some point or another. And that's really exactly 2021-22. This year and next year, these economies have to now decide how they're going to contain their public debt and what's going to give. Is it expenditure that's going to give, or is it taxation that's going to go up, or is a mix of the two? What we have no doubt of is the unsustainability of the debt. Lucky for South Africa, and that is what distinguishes South Africa from many other economies, the domestic capital market is deep enough so that our debt situation doesn't become a balance of payments problem. And the South African capital market is the deepest and most sophisticated amongst all emerging economies, and that's been the saving grace of South Africa. These are trends in capital flows. As I wrap it up, we see that we had the yo-yo in 2020, bond market, equities all going one way, going down, as you can see, and then post 2020 we have more or less normal situations, but still overall trend is capital flow out of the country. And we had Dr. Leila Froux of JSE expressing concern around that, but that will stabilize, in my view, as the global conditions become clear over the next 6 months or so. Money supply interest rates, we've seen in different destinations I alluded to before. We see the United States printing money like like there is no tomorrow. United Kingdom and Eurozone doing similarly, but not as aggressively. But that's because the United States is the currency of reserves, and they have to look at not just the United States, but the global economy. In terms of foreign exchange rate, volatility all over the place, and unless the macroeconomic financials stabilize, these currencies will continue. And of course, amongst them, because of the nature of the South African rand, which is fairly liquid, we see a lot more volatility, and we have seen it over the past 3 decades, a great deal of volatility well above the average. But over the past while, we've had commodity prices helping us, our currency strengthened. We've seen market improvements in the current account like never before, quarter after quarter. That helped the strength of the currency. So these are short-term, as I alluded to earlier on. And on top of it, interest rates are still in South Africa relatively higher than the rest of the globe. These are the trends on commodities. I'm sure you're familiar with all of these. You see that the commodity prices has taken off, and that has been helpful for the South African balance of payments. Of course, the reason the balance of payments has consecutive surpluses is because our import has dropped substantially, our import propensity, and that has to do with both consumer confidence and lack of domestic investment. As a result, we are registering unusual and sustained balance of payments surpluses. Our interest rates are pretty stable, and the Reserve Bank has indicated that they're obviously watching inflation, but they're not going to cause volatility in interest rates, and they are awaiting trends in the global economy. When the Federal Reserve moves, our interest rates will respond. However, our inflation is fairly muted. Although more recently we have seen an uptick, but we are within the range, and therefore the Reserve Bank is likely to keep the interest rates for the time being as stable as possible, but either in this quarter, this coming quarter, or quarter one of 2002, interest rates are likely to go up as inflation begins to notch up on the back of global inflation. To just conclude, I've mentioned all these points that the global economy is recovering from the hammering that it got from the pandemic. Remains serious headwinds in the global economy. Most importantly, lack of political leadership, in my view, which then manifests itself in the form of vaccine nationalism and a whole lot of other partisan thinking. Trade logistics have become a major issue and potential obstacles, and needs attention. South Africa's integration into the global economy is a positive thing in the short term, but industrialization remains our challenge. In the short term, we have seen and I've argued that export will be the driver, but in the medium term, we need to pick up the pace of domestic investment. Marius, I'll stop here, and then we can go to some questions, and let me see if I can stop here.
Thank you, Dr. Abedian, and thank you also once again to our stakeholders for the questions. So we've tried to collate them together in order to address the broadest range of concerns. So maybe just to kick off, it's been quite some time since we've experienced a strong emerging market cycle. The last time was between the period of 2001 and 2011, when we saw the super cycle in commodities. The rand strengthened from 12 rand to 7 rand to the US dollar, and we experienced very strong GDP growth. Obviously, South Africa's fiscal position improved significantly during this period. So the first question to that would be, what would be the signs that emerging markets might be entering a similar period of strong economic growth? And what would this mean for South Africa, and in particular for the budget deficit, rand, and GDP growth?
Marius, as you also highlighted, that point, that period where we had this what is called synchronized growth, synchronized investment, and sustained global growth or super cycle of commodities. So most of these emerging economies in one way or another are commodity driven, and or require sustained inflow of foreign direct investment. So the three requirements are: one, that we need to have a period that global economy is in a sustained growth phase. Now, sustained can be at 5%, 3%, or 8%. Really doesn't matter, as long as we know that the economy globally is going to sustain its growth. That gives the emerging economies and the drivers of growth in these economies a lot of reliability and continuity, which in turn then translates to better fiscal position, better balance of payments position, better inflow of investment into those economies themselves. So we have, and then the third element is some kind of more or less sensible political leadership in many of these economies. In that period that you referred to, South Africa had a fairly economy-focused political leadership in the form of President Mbeki. You had countries like India was growth-focused, you had Brazil growth-focused, you had Mexico growth-focused, and of course China has always been growth-focused. So those are the three elements: reliable, sustainable growth, doesn't matter at what level, some kind of stability in management of these economies, and political leadership in the emerging economies.
Okay, thank you for that. Now, the second part of that question would be, how could South African investors position themselves to benefit from an emerging market cycle, and which asset classes and sectors in South Africa would benefit the most from an emerging market recovery?
Look, typically in South Africa, the asset classes that in the order of priority, if you like, our commodity projects, our mining sector typically is the beneficiary because they export into the demand that the economy on a sustainable basis at the global level will require. Interesting enough, South Africa also has another sector that benefits from it, and that is our tourism sector, because sustained growth means a sustainable and sustained inflow of tourists, especially foreign tourists into South Africa. Bear in mind that in that period that you mentioned, South Africa's tourism sector became the most job creator in the country, creating almost 1.2 million jobs. And the third sector that almost benefits from any growth is the financial sector. By definition, these sectors are derivative sectors, meaning when the primary sector and the secondary sector benefits, then the tertiary sector in South Africa, financial sector, benefits substantially. So those are the three sectors or asset classes that, in my view, will benefit in South Africa.
Maybe just as an aside to that, when we talk about the mining sector, would you agree that the South African market, in terms of the kind of listed businesses that we have, it's maybe a little bit broader? So if the mining sector does well, there's a bunch of other businesses in our economy that's actually servicing the mining sector that would also then benefit from those miners doing well.
Absolutely, the multiplier effect of that in terms of a lot of sectors that input into the mining sector, and that is where our manufacturing and mining are so joined at the hip, quite frankly. With the exception of the auto industry, all other manufacturing in South Africa is very much interlinked with our mineral complex in the country. So yes, a lot of those contributing industries will also benefit.
Thank you for that. So then the second bit of the questions that I have is around the Federal Reserve. So they've adjusted their mandate recently to accept inflation above their 2% target, and to incorporate diversity and inclusion goals in their definition of full employment. So inflation is now substantially above their target levels, and even if we assume a flat CPI from here, their CPI will still be above 4% in December. So their new mandate is being severely tested. So what would the risk be of a policy error by the Fed? And do you think the most likely error would be being behind the curve or over tightening? And what would the key implications be of this on the US dollar yields and then asset prices?
Marius, the Reserve Bank, the Federal Reserve Bank has to navigate two types of fundamental errors. One is if too quickly they tighten too much, they can lead to contraction, even recession. So they have to worry about that. And the Great Recession is a big flag in their meeting rooms. The second one is actually if they don't tighten enough and let inflation get out of hand, then they risk the 1970s stagflation situation, where inflation keeps creeping up, but growth doesn't happen, or growth gets sort of stalled. And that is, they're stuck in this tunnel. You would have seen over the past 2 days, there is a big debate in the American Senate, which has bearing on the second issue, and that is what the Republicans want to introduce as the debt ceiling. If the American government has to abide by a debt ceiling, which means they cannot stimulate the economy, so you can get growth being stalled, and yet inflation creeps up on the back of shortages, on the back of logistical inefficiencies, etc., etc. So those are the two policy errors that we need to watch.
Would you put a likelihood on any one of those being, more likely?
I would put more. I'm absolutely certain. Maybe as Woody Allen says, his confidence is what you have before you know the facts. But I'm absolutely confident or hopeful that the Reserve Bank won't make a decision, a Federal Reserve Bank decision of tightening too quickly to causing contraction. So that I give it less probability than dragging it on, letting inflation to creep up, to become almost outside their control. And then on the fiscal side, growth is not permitted to happen. So they end up with a stagflation as opposed to recession.
Okay, thank you. Okay, then the second part to this whole question about the Fed is, what would a weak US dollar environment and stronger commodity prices mean for emerging markets in South Africa? And then is this an environment where emerging market assets could outperform developed markets?
Definitely it could. If that happens, you could have a situation where the dollar gets weaker and weaker, the rand gets stronger, relatively speaking. We then become a favorite destination for investors, and then if on top of it we can get our domestic obstacles to growth and investment at the same time removed. For example, energy, we can our port infrastructure and rail infrastructure on productive basis can underpin our growth for the next 10 years if we get it right. So it could happen, and our prayer is that eventually the government will get its act together to unlock these and then underpin the growth at the same time that the developed economies do not deliver the type of growth that we can deliver to the global economy.
Thank you. Now, maybe just one last left field question, and that is, I'm not sure about your level of engagement with government lately, but the saying in the investment world often goes that the South African government is long on plans and short on implementation. Are you seeing any changes there? Does it look like we're actually getting the ball rolling and implementing some of these growth initiatives, or are we still in a bit of a stalemate there?
Just for the sake of transparency, Marius, I sit on the investment committee of a national infrastructure fund, and the interesting and positive and definitely very positive new institutional arrangement is that on that committee you have not just public sector, you have independent people like myself, and you have people from the financial sector who are sitting on the investment committee and focusing on allocation of funds subject to and with special focus on implementation. So we see a lot of change of approach, which basically places emphasis on not bringing competencies, but also putting the emphasis on implementation. So yes, I see the green shoot on that front. I also see changes of approach within even Transnet, where we see increasingly the need for bringing private sector operators, private sector investors into some kind of PPP in order to not only have the resources on the financial side, but also have the skills and competencies and operational experience in delivering return on those investments in the key areas of infrastructure investment.
That's great news. Thank you. And I think on that positive note, we've reached exactly 10 o'clock. So I want to thank you, Dr. Abedian. It's been awesome hosting you today. And I hope to host you again soon. Thank you for our audience for attending, and have a lovely day.
Thank you. Thanks, everybody.